Welcome to the Opening Bell Report.
Today, we're looking at a financial analysis arguing that the big 23% drop in RZLV stock is actually a buying opportunity, all because of a misunderstood financing deal.
Right, and let's get straight to it. The first thing I want to talk about is this very delicate trade-off between generating excitement and maintaining professional credibility.
Okay.
When you're writing a piece like this, a contrarian piece, you're essentially telling the market it's wrong. And that's a tightrope.
Sure is.
And right now, this analysis is leaning so hard into the excitement that it's kind of losing its balance on the credibility side.
I saw that right away. The energy is great, but it feels a little unbridled. Are you saying that in its effort to stop people from panic selling, it's using a style that might actually make a serious investor panic?
That's exactly it. The core weakness here is this heavy reliance on sensationalist, almost hyper-emotional language.
Mm-hmm.
We see phrases like, smart money is laughing all the way to the bank, or terms like rocket ship.
And the big red stop sign, can't miss that.
You can't. And look, these things are great for grabbing attention, but they risk alienating the exact audience you want, the sophisticated investors.
Right. When someone with real capital sees that kind of hype, especially with emojis mixed in, they don't see an opportunity.
They see a red flag. They think pump and dump, not undervalued asset.
It's like the difference between a research note and a tabloid. One wants you to think, the other just wants you to react.
Precisely. It ends up feeling less like a calculated investment thesis and more like a gamble, which is a shame because the actual data in here is pretty solid. The presentation is just masking the value.
I get what they're going for. The stock's down 23%, people are scared, so they want to grab him by the shoulders. But it does feel a bit like a late-night infomercial.
But wait, there's more.
Exactly. So how do we fix this? We need to keep that urgency because it is a time-sensitive thing, but we have to do it without the hyperbole. The goal should be to replace that emotional manipulation with data-driven confidence.
That's the pivot. Keep the energy, but upgrade the vocabulary. Let's look at the opening hook. Right now it's screaming, stop, do not touch that sell button. It's so aggressive.
It feels like I'm being scolded.
It does. It just lowers the intellectual bar right from the start. A much more effective way to do it would be something like, before liquidating positions, it is critical to contextualize the financing structure.
Oh, that's a huge shift in tone. That treats me like an intelligent operator, not a panicked amateur. It says, hey, I know what you're thinking, but here's a piece of the puzzle you might be missing.
Exactly. It invites you into the analysis instead of ordering you around. And you see the same issue in the conclusion. It asks if RZLV is a falling knife or a rocket ship.
And falling knife is such a loaded term in finance. It's so visceral.
It is. It triggers your fear response. Just by asking the question, you're validating the reader's panic. Instead, I'd frame it around risk-reward. Something like, does the current valuation imply a structural failure or liquidity discount?
I like that. That's the language smart money uses. They don't catch falling knives, they exploit liquidity discounts. If you want to appeal to that crowd, you have to speak their language.
And there's that other line, the bear trap of 2026. It's catchy, I guess, but it feels a little speculative, almost conspiratorial.
Yeah, like there's some villain setting a trap.
Right. What if we just replace that with significant market dislocation? It's more objective. It implies a temporary market inefficiency you can exploit, not a battle against some shadowy force.
It grounds the whole thing in financial reality. Dislocation is an analyst's word. Trap is a gambler's word. Okay, so let's move on to the core argument of the piece.
Sure.
As I see it, the whole thing really hinges on that price discrepancy. The market price at $3.55 versus the institutional buy-in at $4.
This is the central pillar of their whole bull case. The argument is simple. The big guys paid $4, you can get it for $3.55. It's a deal.
It is a good hook.
But the weakness is in how this institutional floor is presented. The analysis just dismisses the market's reaction way too quickly. It just says institutions bought at $4 and moves on, ignoring why the market sold it down to $3.55 anyway.
Right. Because markets are, generally pretty efficient. If the news was purely good, the stock should be at $4. The fact that it's lower means the market is skeptical about something.
Exactly. And this report just assumes the reader will blindly trust the whales without asking if maybe those whales hedged their positions, or if the deal had a bunch of warrants that effectively lower that $4 price.
That's a huge point. A sophisticated reader immediately thinks, okay, but was there warrant coverage? Because if so, the real price isn't $4. The argument is strong, but it doesn't defend itself against that obvious counter.
And if you don't address the skepticism, the reader just assumes you're hiding something.
So the suggestion here is to bolster this section by acknowledging that fear first, steelman the bear case to make the bull case stronger?
Yes, absolutely. You have to validate the fear before you can dismantle it. For instance, I'd add a sentence that explicitly says, the drop to 355 likely represents retail capitulation or short-term liquidity fears.
So you name the beast.
You name it. You explain why the gap exists. You say it's because of a time horizon mismatch. Panic sellers are thinking about today. Institutions are thinking about 2026. Suddenly, the argument holds so much more water.
That makes sense. It turns the price drop from a scary mystery into a mechanical, almost predictable outcome of market dynamics. It tells the reader the market isn't wrong, it's just operating on a different time frame than you should be.
And building on that, instead of just highlighting the $4 price tag as a number, the analysis needs to explain the implication of that price.
What do you mean?
Well, that $4 level represents where serious due diligence was performed. Institutions don't just throw darts at a board, right? They audit the books, they talk to management. Retail sellers are just reacting to a headline about dilution.
Okay, so the revised version might sound something like, while the retail reaction to dilution has driven the price to $3.55, the $4 institutional entry point implies a fundamental valuation floor established after significant due diligence.
Exactly. Now you're framing the discount as an arbitrage opportunity between emotional sellers and analytical buyers. It's a much more compelling story than just shouting, it's on sale.
It explains why it's on sale. That's the key to confidence. Okay, that distinction is vital. Let's shift gears a bit to the structure of the argument. The report makes this big pivot from the offering to the fundamental pivot about the cash raise and bankruptcy risk.
Right, and this brings us to a critical issue in the logic. The weakness here is that the material treats the $250 million raise as a magic wand.
A magic wand that guarantees the $350 million revenue target for 2026.
Yes, it's this huge logical leap from bankruptcy risk is gone to growth rocket.
I see what you mean. Having cash prevents death, but it doesn't automatically mean you can execute the plan. Just because you can pay the bills doesn't mean you're going to beat competitors trading at 10 times sales. It's the difference between solvency and success.
That is the missing link. The report assumes capital equals capability. And my suggestion is that you have to bridge that gap between survival and growth. The analysis needs to connect how the money will actually be used to hit that revenue target.
So instead of just showing a graph with revenue bars jumping up, we need to explain the mechanism behind that growth. What do I need to see to believe that graph is possible?
You need specifics. Instead of just the graph, the text should mention what that war chest is actually for. Is it for expanding the sales team, new product development, a huge marketing campaign?
Make it tangible.
You have to let the reader visualize the money being put to work. If you say, this cash allows them to double their sales force, then the revenue target suddenly becomes much more believable.
It grounds the growth rocket emoji in operational reality. It treats the company like a business, not a lottery ticket.
And with the phrasing, the text currently says, if they hit that number, we are talking about a company trading at less than 1x sales. I changed that to something more active. Maybe this capital injection removes the liquidity constraint, allowing management to focus entirely on the operational execution required to hit the 350M guidance.
Ooh, I like that. That phrasing does a lot of heavy lifting. It reframes the dilution not as a cost, but as the price they paid for operational freedom. It tells you exactly what they bought with those shares.
It also clarifies the risk. The report uses this visual of cash burn risk being crossed out. That's effective, sure, but the narration needs to explain that the risk hasn't just vanished, it's shifted.
Shifted from what to what?
It's moved from solvency risk to execution risk. And that's a much more nuanced, more honest take that a sophisticated reader will really appreciate. It tells them, okay, we're not going bust tomorrow, but now the real work of selling the product begins.
That distinction is so important for credibility. If you tell me all the risk is gone, I just don't believe you. But if you tell me now they have the tools to do the hard work, I'm much more likely to listen.
That's the essence of it. Acknowledging the difficulty ahead makes the potential reward seem more earned, and therefore more believable.
Let's talk about that visual metaphor. You mentioned the rocket emoji. If we're moving away from hype, what replaces the rocket?
Visuals are powerful, so we don't want to get rid of them entirely. The risk-removed visual where the cash burn is crossed out, keep that. That's a binary change. But on the other side, instead of a rocket, what if we use something that represents an operational runway?
Like an airplane on a runway or a full fuel gauge?
Exactly. A rocket implies this uncontrolled vertical trajectory. It's a gamble. A runway implies a controlled takeoff. Again, we're shifting the entire metaphor from gambling to piloting.
Controlled takeoff. I really like that. It implies there's a pilot in the cockpit, the management team, not just someone lighting a fuse and hoping for the best. Okay, let's look at the final section, the chart and targets.
So this part is about integrating the technical analysis with the fundamentals. And the weakness right now is that the technicals, like the RSI being under 30 and the $12 analyst price target, they just feel tacked on.
Like an afterthought?
Totally. They're presented as these separate bonus reasons to buy, but they're not integrated into the main story of the financing event.
It does feel like a bit of a laundry list. Oh, and also the chart looks good, and also this analyst likes it. The H.C. Wainwright target is just used as a blunt instrument. That's a 3x from here. It doesn't tell a cohesive story.
Exactly. No cohesion. My suggestion here is to weave the technical indicators directly into the narrative of the market's psychological reaction. The technicals shouldn't be a separate chapter. They should be the proof for the argument we just made.
So you'd link the RSI directly to the whole panic selling thesis from the beginning.
Yes. Instead of just saying the RSI is under 30, you say something like, the RSI dipping under 30 mathematically confirms the panic we discussed earlier. It's a sign of emotional exhaustion in the selling pressure.
I love that. Now the chart isn't just a squiggly line. It's hard data proving the human behavior we're analyzing. It validates the whole retail capitulation idea.
It ties it all together. And what about that H.C. Wainwright target? How do we avoid just borrowing their authority?
That's a real risk. If you rely too heavily on, well, this sperm says so, it weakens your own voice.
We don't want to outsource the thinking. So instead of just throwing out the $12 number, we frame it as a validation of the company's long-term potential now that the financing is secure. That analyst target probably assumed the company would survive. Now survival is funded, so the target becomes relevant again.
So the logic isn't buy because an analyst says it's worth 12, but this financing unlocks the path to that $12 valuation.
Precisely. It uses the analyst target as a data point that supports our thesis, not as the thesis itself. And finally, that question in the text, are you going to hold the line? It's a bit
Cliché.
a bit generic, yeah.
I'd suggest asking something that forces the reader to synthesize everything. Like, do these technical oversold conditions align with the fundamental valuation floor established by the offering?
That brings the reader right back to the central thesis, the mismatch between the emotional price and the analytical value. It forces them to connect the two halves of the report.
It really just shows how tweaking the framing can completely change how the information is perceived. We're not changing any of the facts. The facts are strong. We're just repackaging them.
You used a great analogy when we were prepping for this. You said, we need to stop packaging this content in neon clickbait wrapping paper and start putting it in a leather briefcase.
That's it. If your thesis is that the market is wrong and there's deep value here, you don't cheapen that with loud noises. You present it with quiet.
Don't forget to like, share, and subscribe for more.